want to welcome you to adjusting entries again. And this time we're actually going to go through the adjusting entries. And what I'm going to do is put down the original entry and then do the adjustments for that. Okay, so the first we're going to have deferrals, and that's deferred expenses. And remember, that's when you pay it ahead of time and then you're going to use the expense up later. Prime example, that's like the first one's insurance. Okay, the company purchased a 1-year insurance policy for $18,000 on October 1st. So our original entry is going to be, would be a debit to prepaid insurance. For $18,000, and we will credit cash for $18,000. Okay, that's my original entry. Now, December 31st comes around and we need to do the adjusting entry. So it's prepaid insurance, so what we want to do is expense it out. So we'll debit insurance expense, and my credit's going to be to prepaid insurance because I want to reduce that one. Okay. Now, how much have we used? Well, we've used October, since it's October 1st, so it's October, November, and December. So we've used 3 months of it. Okay, so what I'm going to do here is put, instead of just putting a number in, I'm going to calculate it for you. The original cost was $18,000, and I take that times 3 months divided by 12, or it gives me $4,500. Okay, so that's how much we've used up, is $4,500. So that's the first one. Okay, we got it October 1st, so we had it October, November, December, so we had it for 3 months. We've used 3 months. This was for a 12-month policy, so you could take 18,000 divided by 12 and then take it times 3. That's the same difference. Okay. Then we have the deferred revenue. August 30th, the monthly report received $6,000 in annual subscriptions. Now this is not as bad as it looks because I don't tell you how long it's passed, but it's monthly, so that means you get it once every 12 months. Okay, and it's August 30th, so we don't want to count August. But for the entry we'd have for the company would be a debit for cash for $6,000, and we would credit unearned revenue. I'm just going to call it that today for $6,000. Okay. So now how much have we earned? Well, it was August 30th, so we start with September. So it's September, October, November, December. So we've earned 4 months of it. So we want to debit the unearned revenue. And we would credit then the revenue account, probably subscriptions. Okay, that would give me the book. But then for the calculation, we would take the $6,000 times 4 divided by 12, or $2,000. So that's what we've earned, is $2,000. Okay, that's the deferred revenues. So we had deferred expenses up here, which is your prepaids. How much have you expensed out? How much have you used up? And then your deferred revenue, which means they paid you ahead of time. So how much of that have you earned? The next type of thing that we have is the accruals, and we have accrued expenses and accrued revenue. We're going to do the accrued expenses first. So ABC Company borrowed $10,000 on November 1st for 1 year, and for 1 year, interest rate 6%. Okay. So we would do cash for $10,000. Since we borrowed, it'd be public notes payable. And that would be for $10,000. Now, when you borrow, what do you have to pay? Well, you have to pay interest. So that would be interest expense Now it's not due yet because it's 1 year, but we have to record how much interest we have had so far, and the credit would be interest payable. Okay, and how much interest? So it's for 2 months because it's December 31st. So we have equal, remember it's principal times rate, which is the 0.06, times time, which is 2/12 of the year, or $100. Okay, because that's principal times rate times time. So now you notice we don't increase the notes payable, we increase interest payable. Okay, that's the entry we have for that one, interest expense and interest payable. I know in the other one I did wages, but this is another one. I want to do that to show you how the interest payable is associated with the note. So when you pay this note off, though, he's going to have to pay both the note and the interest payable and the interest expense that's incurred for that current month. Okay. The accrued revenue. We accepted a note for a past due account of $9,000 at 9%. Okay, so this is a past due account and we have accepted a note. So that means we got it from a client. So it's notes receivable for $9,000 and accounts receivable, because they've taken off the account for $9,000. Now, since we have a note with them, they owe us interest. So this is a note that they owe us. So it's still interest, but it's not interest expense. It's going to be interest receivable. It's not due yet. That's why they haven't paid it. And this will be interest earned. Now they may call it interest earned, interest revenue, interest income. Doesn't really matter. The calculation would be 9,000 times the rate of 9% times the time. Well, this was March 1st, so you count March, so you had it for 10 of the 12 months. So that's $675. And then the last one we're going to do is the May 1st, the company purchased equipment costing $8,000 using a straight line. Okay, so this is also, we're going to have to teach you a little bit about how to calculate interest. But the original entry would be equipment. And the credit to cash, we're going to assume cash at this point. And that's for $8,000. Okay, and then our entry down here for the adjusting entry, remember it's depreciation expense. And that would be for the equipment. And this one is accumulated depreciation. And that's on equipment. Okay, now the calculation for this is equal. Remember, it's cost minus the residual value or trade-in value. So we would have 8,000 minus the 500 divided by the number of years, which is 5. Now this is going to be, normally we'd be done there. But for our purposes, we're not going to be done yet because this is for a partial year. So we have to take it times 8/12, which gives us $1,000. Okay. So for this one, you take the cost of the asset minus the trade-in. Trade-in value divided by its useful life. Okay, and then like I said, for this class it'll be mainly for the full year, but on this one I didn't. So we take that times the partial year. How many months did you have it out of the 12? Okay, and that gives you the depreciation expense. Okay, that's an example of each of the journal entries. Again, it's the prepaid. And notice we have a liability. It's an income statement, liability or asset, balance sheet. In balance sheet, right there. Oh, I didn't space that, did I? Whoops. That's the balance sheet, income statement, balance sheet. And then this is a balance sheet, income statement, balance sheet. Okay, and this is how you calculate the depreciation on it. So that takes care of journal entries. It's kind of a quick overview of it, but it gives you an idea how that works. So I hope that helps. Next one is going to be on closing entries.